Welcome back to CENTSHIFT, your weekly pulse check on America's economy. In today's roundup, we break down what's really going on behind the headlines. From inflation trends to job market shifts, real estate data, consumer sentiment, Fed policy, and the latest market performance. Stay tuned till the end for practical money moves you can make right now. Let's begin with inflation. According to the May CPI report, inflation slowed to 3.2% annually, with energy prices dropping slightly, but core services like rent and medical care still rising. The Fed's preferred inflation gauge, the PCE index, came in at 2.7%, showing some alignment with long-term targets. Grocery prices are up 0.5% from last month, mainly driven by dairy and produce. These numbers highlight that while inflation is improving, the American household continues to feel the squeeze. Looking closer, regional inflation disparities persist. Urban centers like San Francisco and New York are experiencing slower price increases compared to smaller cities and rural areas, where transportation and housing costs remain elevated. The job market remains resilient. As of last week's data, unemployment is steady at 3.9%, and the economy added 175,000 new jobs in May. Wage growth has cooled to 3.5%, giving the Fed more breathing room. Notably, healthcare, government, and construction are leading job creation, while the tech sector is still cautious. Zooming out, labor force participation has rebounded to 62.7%, largely due to more women returning to the workforce. Meanwhile, layoffs are concentrated in white-collar sectors, while blue-collar and service jobs are holding strong. Remote work continues its gradual decline, with hybrid roles becoming the new norm in major metro areas. Shifting to the housing market, mortgage rates are holding near 6.8%, with 30-year fixed rates showing little movement. Inventory remains historically low, pushing home prices up 1.9% month over month in key metros like Phoenix and Miami. However, new housing starts have picked up, and rental vacancies are rising, suggesting we may see relief by late 2025. Additionally, the commercial real estate sector continues to face pressure, especially in office spaces. Vacancy rates in downtown cores like Chicago and San Francisco remain above 20%, and REITs tied to office properties are seeing mixed performance. Let's talk about the markets. The S&P 500 hit a new all-time high this week, driven by tech and energy sectors. However, volatility remains as investors wait for clear Fed signals. The bond market has priced in one rate cut before year-end, likely in December. Meanwhile, Bitcoin is holding steady above $60,000 as institutional interest continues. In the commodities space, oil is hovering around $78 per barrel, and gold continues to trade near historical highs. Market watchers are also closely monitoring China's slowdown and its impact on global trade and U.S. multinationals. So what's the Federal Reserve up to? In his latest remarks, Chair Powell signaled that the Fed is in a wait-and-see mode. No rate cuts are expected this summer unless there's a sharp deterioration in job numbers. The market is expecting a policy pivot in Q4, contingent on inflation and consumer spending trends. The Fed is also keeping a close eye on credit conditions. Banks have tightened lending standards, especially for small business and personal loans, which could slow down economic momentum if prolonged. Consumer sentiment is recovering, but it's fragile. The latest University of Michigan survey showed confidence rising slightly, driven by optimism around wages and job security. However, credit card delinquencies are ticking up, especially among Gen Z and millennials, suggesting rising financial stress beneath the surface. Retail spending remains strong in categories like travel and electronics, but there's a notable pullback in home improvement and luxury goods. Meanwhile, household savings rates have dipped to 4.1%, signaling more dependence on credit. So what should you do about it? Hold off on large purchases unless necessary. Prices are still inflated. Build an emergency fund. Even a small buffer helps during uncertainty. Lock in fixed-rate debts if possible before future rate changes. Focus job searches on stable, essential sectors. Consider reallocating some savings into CDs or high-yield savings for short-term goals. Stay diversified. Don't rely too heavily on any one asset class. Use this time to review your spending habits and reduce discretionary expenses. That wraps up this week's U.S. Economic Roundup. If you found this helpful, like, subscribe, and share CENTSHIFT with someone who wants to stay financially sharp. And remember, in uncertain times, clarity is your greatest asset. See you next week.